Welcome to This Explainer. Right now, we are literally watching a massive, systemic collision unfold right in front of our eyes. On one side, a historic, seemingly gravity-defying AI tech boom. On the other, dangerously deteriorating macroeconomic fundamentals. We're looking at an entire financial system in active tension, and honestly, the data behind it tells a truly fascinating story. Let's get into it.
So, what happens when an unstoppable AI boom meets an immovable economic reality? That is the core question we're answering today. It's kind of this bizarre paradox, right? Could the tech market's sheer euphoria actually be engineering its own downfall? Today, we're diving deep into the data to find out how an unprecedented success story might actually be creating a catastrophic breaking point.
Here's our roadmap for today. We're going to hit the AI market crescendo, uncover some hidden macroeconomic frictions, explore the wealth effect trap, look at how we're approaching the breaking point, and finally, unpack the AI bull paradox.
All right, Section 1, the AI market crescendo. Let's dive right into this first massive force, the unprecedented euphoric momentum of the tech market. Because, wow, equities are hitting absolute historic highs right now. I mean, the S&P 500 has surged to 7,432, the Dow has crossed 50,000, and the Nasdaq soaring past 26,000. And what's wild is that this upward roar is almost entirely driven by massive AI capital expenditures. The market is just accelerating, seemingly brushing off global frictions like the 10-year Treasury yield creeping up to 4.6% and crude oil hovering near $97 a barrel. It's like those headwinds don't even exist.
But what's truly fascinating is who is actually pulling the market up to these dizzying heights. It's being led by a highly concentrated, incredibly powerful vanguard of companies. You've got Nvidia, acting as the absolute hardware engine for agentic AI, sitting at a staggering $5.4 trillion market cap. Then you have SpaceX, filing its S1 and targeting a $2 trillion valuation with its multi-planetary infrastructure. And of course, OpenAI, pushing foundational LLMs and eyeing a massive $852 billion valuation ahead of its own IPO.
And the sheer velocity of capital extraction happening here is mind-bending. Just look at these overlapping IPO timelines. SpaceX is registering its S1 today, and OpenAI is expected to file its initial paperwork this Friday, aiming for a September 2026 public debut. When giants like SpaceX and OpenAI go public basically back-to-back, they act like massive vacuums, sucking billions of dollars in investment capital out of the room at the exact same time. It's an unprecedented extraction of capital at the highest echelons of tech, and it's absolutely testing the limits of public market liquidity.
Which brings us to Section 2, hidden macroeconomic frictions. Because while Silicon Valley is booming, we have to abruptly pivot to the immovable object in our story, the underlying cracks in our global macroeconomic foundation.
See, outside of that tech bubble, the real world is under intense stress. We are now 12 weeks into the Iran conflict. And yeah, while the oil market has become visibly less sensitive to political rhetoric, dropping slightly after some recent peace deal optimism, the baseline price of crude energy remains a sticky, structural threat to inflation. The initial shockwaves might have settled down, but the high watermark at the pump, which is deeply embedded in global supply chains, is absolutely still there.
And this brings us to a major policy dilemma. Incoming Fed Chair Kevin Warsh is relying heavily on the Dallas Fed's trimmed mean PCE deflator to justify dovish rate cuts. But here's the trap. That specific model intentionally throws out extreme price swings. So sure, it looks incredibly smooth on paper, but it structurally lags behind reality because it completely ignores sudden real-world shocks, like, say, new tariffs or massive oil spikes. Just like this exact same model fueled the infamous transitory inflation era a few years back, it's currently offering the Fed a dangerously false hope on inflation today.
And you know what? The broader markets are starting to wake up to this, creating a dramatic, hawkish cascade. It goes like this. First, the oil shock drives up baseline energy prices. That pretty much guarantees sticky inflation, stubbornly sitting above the Fed's 2% target. Then, this reality eventually bleeds into the April FOMC minutes, leading to widespread committee dissent. And suddenly, bam, the pivot. A majority of participants are now signaling that policy firming might actually be appropriate. Just like that, rate hikes are right back on the table.
To see exactly how weird and polarized this global stress gets, let's look at the UK and Japan. It's basically an incredible island nation stress test. Both countries are besieged by cranky bond markets and the Strait of Hormuz energy crisis. Now, the UK is just hoping to model through, and their equity market reality reflects that. The FTSE 100 is up just 4%. But Japan? Despite an astonishing 87% vulnerability to energy imports, their Nikkei 225 is up a massive 19%. How does that make any sense? Well, because they have a secret weapon: absolute dominance in the AI supply chain via companies like Tokyo Electron and Kioxia. AI is literally shielding their equity market from a brutal macroeconomic reality.
All right, moving to Section 3, the wealth effect trap. Let's bring these two opposing forces together to see exactly how they interact. Enter the wealth effect feedback loop. This was beautifully identified by BCA researchers Arthur Budagagian, and it works like this. The tech surge creates historic, unprecedented wealth. This massive wealth effect then acts as a robust spending machine across the entire economy, driving major retail beats. But here's the catch. This unexpectedly robust economic growth completely counteracts any disinflationary forces, keeping inflation dangerously sticky, meaning the Fed is backed into a really tight corner, forced to delay rate cuts or even implement steeper hikes. And that puts suffocating pressure right back on the very equity markets that started the cycle. It's a massive loop.
Just absorb this data point for a second because it's wild. American stock holdings have hit a record 250% of disposable income purely via this tech surge. That's a staggering number. And it matters deeply because this massive wealth generation artificially insulates the consumer economy. People look at their retirement and stock portfolios, they feel rich, and so they keep spending. And because they keep spending, inflation stays hot and the Fed remains completely cornered.
So, Section 4, approaching the breaking point. The crucial thing to understand here is that this feedback loop isn't just a quirky economic model. It is actively pushing the financial system toward an absolute breaking point.
Historically, bond yields and share prices exhibit a negative correlation. When one goes up, the other goes down. It's the standard seesaw of the financial world, right? But right now, we are witnessing a super dangerous anomaly. Both the S&P 500 tech boom and the 10-year Treasury yield are climbing the ladder together at the exact same time. And the hard rule of the last 30 years dictates that when bond yields cross above the Fed funds rate, the central bank is violently forced to hike.
In fact, strategists warn that the AI-powered bull market faces a catastrophic challenge if the 10-year Treasury yield breaches a literal 5.00% systemic breaking point ceiling. We are sitting at 4.60% right now. The pressure is really building underneath, and that ceiling is right above us.
Which brings us to Section 5, the AI bull paradox. Let's see how all this data builds to a harsh, unavoidable reality. Here is the ultimate paradox, the synthesis of everything we've just talked about. The tech boom is actually manufacturing its own systemic demise. The historic wealth effect generated by the AI vanguard makes consumers feel rich, which artificially insulates the economy. This insulation sustains sticky inflation. That sticky inflation forces the Federal Reserve to be aggressively hawkish, driving bond yields right toward that 5.00% breaking point. So AI's very success is actively destroying the economic environment it needs to survive.
Which brings us to the inevitable, and frankly, painful fix. As the data suggests, only a meaningful equity sell-off is likely to pull bond yields considerably lower. What does that mean in plain English? It means that to save the foundational macroeconomic environment and kill inflation once and for all, the AI stock bubble basically has to be intentionally popped. The global equity risk-reward scenario is inherently compromised by its own success right now.
Which leaves us with this final, crucial takeaway to ponder. The tension is incredibly active. The breaking point is near. So can this unprecedented AI bubble be let down gently by the markets and the Fed? Or are the macroeconomic cracks so deep that we are already locked into a hard landing? Thanks for joining me on this explainer. I really hope this helps you see the broader picture behind the daily market headlines.